When you extend the filing date of your personal tax return, that does not extend the date to pay. What that means then is we have to do basically a calculation to figure out what do we think we're going to owe and pay that in April.
Yes.
So that when we file our tax return in October, that we either have a small refund, or maybe we owe a small amount of money. But the IRS gets real upset if we file a return and there's a bunch of money owed.
From Ray & Associates Studio, this is Unsuitable, a management and financial services podcast for entrepreneurs, tenured business leaders, and others who are ready to look beyond the suit and tie culture for meaningful, measurable results. I'm Doug Hauser. We are nearing the end of the year, which means tax prep is once again on the agenda. As you prepare to plan and think about filing your 2019 tax returns, there are several considerations to keep top of mind. Today's guest is going to point us in the right direction. Chris Axene, a principal and federal tax expert extraordinaire with Ray, and one of our regulars here in Unsuitable, is here to talk about what you can do to become better prepared for the upcoming tax season. Welcome, Chris.
Thanks, Doug. Glad to be here.
Yeah, appreciate it. So, talking about preparedness, I was thinking about this with my one daughter who's still at home this morning. I used my famous line on her. Don't make your lack of planning my crisis. Is that a fair assessment?
Fantastic,
of what you see?
and I absolutely I was living that this morning myself with a client that came in, and we were reliving what happened during the second busy season, and being a perennial procrastinator, that was tough for me to get out. In terms of waiting till the last minute to bring their stuff for last year before we can even start the stage to talk about how we're going to plan for this year. And of course, it's November,
right?
And there's only 1 month left in the year.
And right, we're still dealing with the prior year, right?
That's right.
And you're asking for information, and you get the old response.
Well, you get I know, I owe you stuff, and I'm sorry, I'm such a bad person, but I'll get it to you. Or is it too late? Was it too late?
Like secretly, maybe that's what they were hoping
well,
for, right?
Yeah, maybe they get a free pass. If it's too late, we'll just skip this one and move on to the next one.
Use last year's numbers and estimate, right?
Well, that is an option. It's a kind of a last resort, but sometimes you have to do that.
Yeah. So if I'm thinking about preparing for year end as we're getting close to the end of 19, what with the Tax Cut and Jobs Act that came into play, that threw a lot of curveballs into the.
It touched so many different areas of the tax code. I don't know that it left any stone unturned, so to speak. Which is, accountants' full employment act.
Right.
Is another
like
phrase
that.
for it. Yeah. There's just so much going on in different aspects of the tax code that impact individuals, and whether they're employees in their own personal returns, or individuals that are business owners that are running a business. In 2018 was the first year that the Tax Reform Act applied to.
Sure.
The whole industry, CPAs, professionals, and the IRS, quite frankly, a lot of it was guessing on how this stuff was supposed to be implemented. And over the course of the year, the IRS issued some guidance in some areas to help, but there were still lots of questions that were unanswered about how appropriately to report some of these things.
Sure.
And we're still there. We're still waiting on guidance, and that's a lot of how this works. Is it'll take several years to work out exactly what we have.
Still writing the rules
right?
as we go.
We got to pass the bill first to know what's in it, right?
Right.
Yeah. So we passed it. Now we got to live with it for 3-4 years to figure out how to comply.
Yeah. So if I'm a business owner, what do I need to be thinking about, though?
Well, right. So we also call that the 199 Cap A. So I'm a code head, and I live in that world. So that's what that means to me. And what that is that's the we get a reduction in the tax rate, pass-through income from a business, if you meet the criteria, what counts, and all the nuances of a phase out, and the benefit gets reduced if you make too much, and
right.
some of those things are still being worked out and refined, I suppose, if you will. But part of the planning for that is understanding one of the big parts of it is the owner compensates themselves for their work in the business and then net profit after that.
Right.
Well, the compensation from the business is not eligible for this benefit in reduction in the tax rate. So they're going to pay at the top tax rate at 37% if that's what bracket they're in, versus business income that would be taxed at a top rate of 29.6%.
Gotcha.
With that 20% benefit baked into it. So planning around, well, is there the ability to work around to maximize the overall tax rate, factoring in compensation and net profits from the business, and there's a calculus to that to figure out you can maximize your overall benefit by appropriately adjusting comp within the range of still what's being reasonable to yourself and to others that are employed in the business. So that's one of the big things. But in order to first be able to have those kind of conversations, what happened in the past can be helpful for what we do in the future. And if we've got a client that waited 10.5 months to file their prior year tax return, that doesn't help us help them in terms of trying to save tax in the future.
Because the key is you want to sit down, obviously, prior to year end and do some planning, understand what the business's outlook is for the year.
That's right.
And try to figure out what's optimal.
Yeah. And certainly for those clients that don't procrastinate, you have those conversations. And because there's valid reasons why tax returns get filed and personal returns in September and maybe early October, because you're waiting for information from outside third parties that's just not available.
Right.
And when that happens, and that's life, and that's easy to deal with, and because it's easy to deal with because you're meeting with those clients outside of that context during the year, talking about how the current year is going, and you're managing with book income, which is not taxable income.
Right.
There can be differences there, but you've got at least a starting point to have that conversation, in June and in July, August, etc., and instead of waiting until November.
Yeah, some idea at least is better than none.
Right. And for no other reason, because you still have 5-6 months of which to do something.
Right.
As opposed to less than that.
Well, and you brought up an interesting perspective about the extension of returns. I've heard a lot of noise about, not only has it impacted individuals, but obviously a lot of K-1s and things like that are getting delayed. So that's just kind of pushing through the system and causing further delay.
Yeah, and absolutely. And historically, it had been a problem because the due date for certain types of returns extended due date happened to be the same due date ultimately for individuals, 10/15. And you can imagine if you were getting the K-1 on 10/15, and your personal return is due on 10/15, that's not a lot of turnaround time. And then so that causes problems for clients. It causes problems for us as preparers and lots of stress and more sleepless nights working. And so fortunately, the IRS implemented some changes to due dates. It's been in place now for probably 3 or 4 years at least, where they moved up by 30 days the due date of all pass-through type returns like partnerships and S-corps.
Sure.
And so the big ones like hedge funds and alternative type investments that are typically structured as partnerships that would issue K-1 documents, which, for those that don't know, similar to like a 1099 or a W-2. They're going to give you, the owner, the investor, something that you then need to give to your accountant because it's going to have income on it, deductions, et cetera, that is needed in order to complete your return. Yeah. And so the good news in that respect there is the due date for those returns now is September 15th extended. Right. So we at least have 30 days. That, however, doesn't address those clients that maybe are new to that type of investment that previously never had to extend their tax return.
Right.
And we're going to them in busy season saying, okay, tell me what you have. I'll have this new investment. And as you learn more about it, it's going to issue a K-1 to you. When is that going to be issued? Well, I don't know.
I don't know.
Well, let's check with your broker. Oh, not till minimum till at least till August. Well, we got to extend your return now.
Right.
Why is that?
Yeah. We're not going to have the information.
Right. And some of those, even though you may be a small investor, some of those can still kick off a material amount of income that would, that causes a tax that we need to wait and we need to extend. And for some clients, that causes them the heartburn because they've never done that before. And they're worried that extending a return is an automatic red flag for an audit, which is not true.
Right.
As we've just talked about, there's perfectly reasonable explanation and circumstances of why you have to amend. The information isn't there.
Right.
And so it doesn't lead to audits in and of itself. One thing that, for the audience that I constantly have to remind clients about, though, is when you extend the filing date of your personal tax return, that does not extend the date to pay.
Right.
Right. So there is no extension of time to pay. So what that means then is we have to do basically a calculation,
An estimate, right?
to figure out what do we think we're going to owe and pay that in April.
Yes.
So that when we file our tax return in October, that we either have a small refund, or maybe we owe a small amount of money. But the IRS gets real upset if we file a return and there's a bunch of money owed, so they're going to charge interest and penalty on that.
Yeah. Speaking of the IRS, have you seen much change in enforcement attitude or diligence since the Tax Reform Act was passed?
It's too soon to tell on that because
Okay.
the IRS does not audit in real time.
Mm-hmm.
So the 2018 tax returns were the very first year that tax reform would apply to. And so the reality on that is some of those clients just filed their 2018 returns.
Okay.
So the IRS is not going to audit them now if it comes up on audit, it's going to be probably 2 years.
Yeah.
So we're going to get into, as we get into 2020, the probably latter half of 2020 and maybe into 2021, where we're going to see where is the IRS focused on with regard to tax reform.
Gotcha.
And auditing. And certain areas we suspect, and we may have read about that the IRS has said, yeah, we're interested in making sure taxpayers are complying.
Mm-hmm.
199 Cap A, the business deduction, is one of them.
Yes.
Because there's opportunity for
gaming, as we
for
say.
gaming the system. Thank you. Right. And so I expect enforcement around that to pick up. As well, depending on what type of business entity you are, if you're still a C Corp.
Yep.
Because the tax rates on C Corps as a part of tax reform came down.
Yes.
It's now a flat rate of 21%. It's actually now lower than the individual tax rate.
Yep.
Because of that, there may be some game playing to try to keep profits within a C Corp. And so I expect some old and cold tax rules to come back into favor in terms of focus of IRS on audits. And
Interesting.
Yeah, so accumulated earnings tax is one of it's been around forever.
Haven't heard much about that in a while.
Well, you haven't, because when C Corp rates were closer to individual rates, there was really no reason to play the game and keep money in a C Corp. But now there might be.
Yeah.
And so I expect to see some increased enforcement activity in that regard too.
So if I'm a business owner, beyond obviously sitting down with a professional like yourself prior to year end and walking through some of these issues, what should I be thinking about on my own in terms of preparing and planning? What are the things that I can do prior to sitting down with you that would help in this process?
Well, first and foremost, it's understanding the role the CPA has, whether that's somebody internally that they're willing to, share information with, or their external accountant. We're here for a reason. We have a role to play. We can help when you give us the time to help you.
Right.
As we say, I'm more effective when I'm a planner versus being a fixer after the fact. So understanding that, having that mindset of the CPA is your friend, is on your team to help.
Right.
Give them the opportunity to help. be willing to meet with them.
Yeah.
When they call and say, hey, it's been a couple months, or it's quarter, quarter just ended. Let's get together, and you can clue me in on what's going on in your world.
Right.
Be open and honest and willing to have those conversations.
Right.
About how the business is going, how, in areas where it's maybe not going as well as they'd hoped it would be.
Sure.
Regardless of whether that's something that we may be able to help with directly, we obviously most of the time have a large network of other professionals that may be able to help.
And the other thing I see too, there's so much going on in terms of transactions with businesses, some type of event, whether it's sale to insiders, family transition, ESOP, or third-party sale, anything like that, is that, to your point, and we're dealing with this now, where we have a client that went through a transaction and we weren't included in the planning process, so you're fixing. And then that to me is a big no-no as well.
Well, you're going to leave dollars on the table potentially.
Yeah.
And maybe not get the best deal that you could have.
Right.
And I see that all the time. I've, in the course of my career, I've probably been involved in, let's say, 100 M&A transactions, most of which on the seller side of the table. And I've seen, I hate to call them tricks, but I've seen all kinds of things in LOIs and sale documents, and that maybe don't necessarily line up with conversations that the buyer and the seller may have had.
Right.
And this, even when they are coming to me, the seller will, oh yeah, this is the conversation I had with buyer, and they said absolutely you're going to sell your stock.
Yeah.
And okay, well, I'm a skeptic. Prove it to me.
Right.
Show me the document. Show me the fine print in the document, and then I say, look at this. This is not. Technically it's a stock sale from a legal perspective, but it's an asset sale from a tax perspective, and that has potentially different consequences for you as the seller.
Right.
So when you know all those things up front while you're still in diligence and negotiating the deal, there's obviously a better opportunity to be able to change the outcome.
Again, sometimes you get folks that are focused on, they see that top line dollar number that they think the transaction value is going to be, here's what it's going to be. But as you suggested, that's not really what they realize.
And I hate to, again, sound biased, but I absolutely agree with you. They see a number and they fall in love with the number and they start spending it. And I think the buyers understand that.
Sure.
And maybe sometimes the unscrupulous ones take advantage of that.
Looking ahead into 2020, obviously an election year, and we certainly don't want to get into politics and all that, but what changes, if any, do you see coming, or areas of emphasis, if you have anything that sticks out?
Quite frankly, for the last 15 years or more, we've had uncertainty in the tax code in terms of long-term crystal ball and how cloudy or transparent it is. And while the Tax Reform Act, we have some certainties with regard to time periods and what was passed. All the individual stuff was temporary, and right now is set to expire after the end of 2025. Well, obviously, we're going to have more than one election between now and then, and tax reform and tax law is only as good as the next Congress that comes in and changes it.
Right.
So when you factor all that in, the planning is, well, geez, I don't have a long-term window.
Right.
I can plan. I can tell you, where we think we are right now. This is what we know because this is good right now. Doesn't mean it's not going to change in 2-3 years.
Right.
So to the things that you can take advantage of them now.
Yeah.
Again, business income deduction, trying to maximize that as much as you can. Their M&A is still hot.
Yeah.
Lots of dollars looking for deals.
Yeah.
And if you're on the seller side, work with professionals and try to maximize your deal. And easy for me to say, be willing to walk away if it's not right.
Yeah.
The worst place to be is where you see a number, you fall in love with it, and now you can't walk away, and the buyer has you, and now you're just going to do whatever deal they want to do.
Yeah, you get sucked into that deal, and it becomes emotional.
When you have the chips and you don't have to sell,
Right.
You're the one holding the cards, and you can then be in a better place to negotiate.
Now, you talked a little bit about these so-called sunset provisions because of the way the act was passed. Now, was that due to federal budget restrictions, or what was?
That's right.
Okay.
Yeah. So the whole sausage, the process of how the sausage gets made is it's all about a 10-year scoring and how it impacts the deficit, et cetera. And because at the time we needed a simple majority, the Republicans in the Senate, to ultimately pass, a measure of the bill at whatever 51%.
Right.
The method to do that required that the overall impact on the finances be neutral after 10 years. And so they look at the 10-year period.
Sure.
And so that's why what was important to them, so you can look at the permanent stuff.
Mm-hmm.
So stuff that, as of right now, is permanent, that all on the corporate side.
Right.
So, and I think the idea behind that was, well, we're trying to incentivize business. We want to, manufacturing, bring that back to the United States. We want to incentivize manufacturers that are still here, been here. And so all that stuff on the corporate side is permanent.
Yeah.
In order to ultimately make the equation balance at the end, most of all of the individual side of the tax reform is temporary. And that includes the big estate and gift tax stuff too.
Okay. So even though, and to be fair, that's proven to be a fallacy because the obviously the deficit has ballooned astronomically. So does that in your mind put some of those changes in more jeopardy perhaps, or too soon to tell really?
I think it's too soon to tell. That said, as what we have seen from the past, when you look at things like bonus depreciation, we get used to, for lack of a better way to say, we get used to the handouts.
Right.
And so when they are on the verge of going away, that causes people lots of angst.
Yeah, absolutely.
Bonus depreciation came out of 9/11.
Right.
In an attempt to spur the economy and expensing and of fixed asset purchases.
Yeah.
And it's gone through various iterations, and it was in fact scheduled to be phased out prior to this tax reform act, and they brought it back.
Yeah.
Just as an example. So, notwithstanding that some of those things are temporary in nature, if to the extent that they provide a benefit to individuals, they're going to get used to getting it.
Sure.
An example that is the higher child tax credit,
right,
and $2,000 per child under 17, and the big part of that is increasing the AGI limit on when that benefit phases out.
Gotcha.
Previously, if you earn more than $100,000 a year, you weren't going to get child tax credit.
Mm-hmm.
Now you can earn up to $400,000 a year and still get $2,000 per child.
Yeah.
So there may be some calls as we get to 2025, if nothing else happens in the meantime, to say, oh, this thing is about to expire. Well, maybe we don't want that. So maybe we got to get together and figure out how to keep it going.
Yeah. Good luck with that.
Well,
right?
yeah, right.
As you told me eloquently though once before, you said, if we have another one of these tax reforms, you said I'm
out the door.
I'm not doing it.
I'm done. I just. I was not in professional practice for the '86 Tax Act. I'll say it that way. So I missed that one. I've gone through this one. I'm not going through another one. Can't.
I don't blame you. Awesome.
It's just too much. It's just too much to try to keep up with.
Yeah, it is. Well, thanks, Chris. I appreciate your insight. I guess the key takeaway here is plan. Again, don't make your lack of planning our crisis. Right?
That's right, and your CPA is your friend.
Yes.
It's don't look at it like you're going to the dentist. We're here to help.
Right. Absolutely. So that's great stuff. So if you want to hear more business tips and insight, or to hear previous episodes of Unsuitable, visit our podcast page at www.raycpa.com/podcast. Thanks for listening to this week's show. You can subscribe to Unsuitable on iTunes or wherever you like to get your podcasts, including YouTube. And while you're there, please leave us a review. I'm Doug Hauser. Join us next week for another Unsuitable interview from an industry professional.